There's the closing bell on Wall Street, and now it's market domination overtime. So let's go check on where the major averages ended the session. The Dow, a little bit more in the green, up 0.1%, 71 points, still not huge. The S&P 500, though, with its gain on the day, did manage to close at another record for the second day in a row. It also actually touched an intraday record over the course of the day. Didn't quite close at that intraday record, but still higher on the day. And then the NASDAQ up very slightly as well. I wanted to take a look at what went on in the bond market today also, Shauna, because we did hear, first of all, we got the Fed minutes from the last meeting, and we heard from Raphael Bostic talking about all of the things that the Fed has to weigh right now.
Yeah, and you're talking about how much uncertainty there is right now when you compare tariffs, when you compare some of the inflationary potential policies, and then you compare that to some of the policies that could be rolled out from the administration that could be deflationary, and how complicated the road is ahead here for policymakers right now in making that next decision and what exactly that timeline is going to look like. I think a lot of the fact that we'd had more of a muted reaction to the Fed minutes was nothing was too surprising, right? Very much policymakers are still waiting to see further improvement in inflation. That has very much been clearly communicated from Powell in the past and very much clearly communicated from a number of the policymakers that we've heard from here over the last couple of weeks. When it comes to today's action, I think very much we are seeing reason for investors to keep buying. We're seeing that clearly reflected in the fact that the S&P closed at another record high, but also that broadening story that we have been talking about. That was clearly reflected in the sector action that we saw today.
Yeah, let's take a look at the sector action real quick, and then I want to come back to some of the trending tickers and just like the big moves that we've been seeing in individual stocks. But here's the sector action. Healthcare actually leading gains today, up 1.25%, along with consumer staples and energy. Materials falling today, led down by a company called Celanese, chemical company that came out with its results. But going back over and taking a look just quickly at how some of the trending tickers of the day closed, it just shows you again some of the big moves here. And some of this is short interest, right? And I believe our Josh Schaefer just wrote a story about the big short interest and the big short squeezes that we have seen. Supermicro Computer, one of them. Adam Johnson at the top of the show saying he likes this company fundamentally, but he doesn't mind that it's getting short squeezed. It's up 8% on the day. Hims and Hers, as we talked about. Yes, bought a home blood testing company, but the stock is up, as you said, 600% over the past year, up another 18% today. Celsius up 15%. I don't know that there was anything in particular. So just, you get an idea here. Yes, SolarEdge did come out with earnings, but a lot of this stuff is people once again looking for these little opportunities.
Yeah. Any reason to remain optimistic here. Yeah. All right, well, another muted day of action on Wall Street to a certain degree, but the S&P 500 notching another record high. Our next guest is saying that markets, though, are taking on a mentality to sell first. And we're seeing this year is already trickier than it was just last year in 2024. We want to bring in Dave Mazza. He's Roundhill Investments CEO. Dave, it's great to see you again. So walk me through that thesis there, what you think maybe that signals about the days and months to come.
Yeah, no, we believe that we're in a stage of shoot first, ask questions later. Of course, we're in the third year of a bull market. There's still a lot to be excited about from the economy and job growth and inflation generally coming down, but still being pretty stubborn. And then earnings, which actually were decent, if not too good, depending upon your perspective. But the challenge is that because of the amount of uncertainty that has increased, investors are taking any bit of bad news really poorly. And because they want to protect the gains, the historic gains they've had over the last 2 years, are willing to sell first and then ask those questions later.
And yet the S&P 500 closing at a record high, Dave. And this gets to kind of something I've been noticing recently, which is there seems to be a vibe and action disconnect, right? There is that sort of attitude you're talking about people being jumpy, and yet stocks at record highs. So how are you thinking about that sort of seeming disconnect?
Well, no, it's interesting, right? So I think markets are climbing another classic wall of worry. We're making new all-time highs almost every day, but there's a lot of questions that come with it. And I think you're absolutely right. Before we got into the current state of the market, especially with the questions about tariffs and then what's the Fed going to do about these inflation numbers that we're seeing, is that was really kind of a vibes market. And maybe we've been in a vibes market and economy for a long time. And so I still think particularly retail investors are positive on stocks, positive on the markets. Vibes are good, but the market's become fragile. And some of that's normal, right? Again, 3 years into this bull market, but this fragility has been showing some cracks. Look at the misses on cloud revenue from Amazon, Microsoft, and others. Those stocks were really punished, but at the end of the day, they were growing at 30%. especially on massive numbers. So normally you would say, all right, well, this is generally a positive, but investors have become so accustomed to quarter in, quarter out, these big companies, especially whether it's the Magnificent Seven or the hyperscalers, spending and growing. And if that growth is slowing, I think it's getting harder for people to continue to pay up for multiples where they are right now.
So Dave, what does that mean then for positioning? How should investors then be thinking about the opportunity as it stands?
Well, it's interesting. One of the things that we've been thinking about for investors who still want to be exposed to the market is covered call strategies. So you can still maintain some upside with a covered call. Of course, you're capping it, but you're using this uncertainty and the increase in volatility, which we think is going to be the norm, not the exception, to harness that volatility to provide you income along the way. So it's a way to still be exposed to the market, take a little bit of risk off the table, and do so with reducing the overall volatility of a portfolio.
And how are you thinking about the Mag 7 right now, Dave? Because we've obviously seen a lot of dispersion within the Mag 7 this year. We've not seen them collectively leading the market like they had been. I know that's something you pay attention to. So what does that portend for how the overall market's going to perform?
Yeah, I think last time I was on, I was still kind of pretty bullish on the Magnificent Seven because of the earnings expectations that we were continuing to see. And what ended up happening was those stocks, especially if we think back to the end of last year, which now seems like not months ago, but years ago, they just were ripping higher on a daily basis. And so their multiples expanded. They essentially, their multiples expanded so much that their earnings growth looking forward is not as attractive. And so while we're still positive on those names, we're definitely a bit more cautious. One of the reasons why we think a covered call approach can make sense. Of course, the NVIDIA earnings are going to become the new make or break element. NVIDIA earnings have become a macro story along with CPI and the jobs report. And I do think if we see a smidge of disappointment there, because then the stock, of course, will get hammered in this sell first mentality. But it hasn't really been trading that great thus far to begin with. And so perhaps actually if we see just some okay earnings, if not good, then I think the market could probably be propelled higher.
Dave, I guess when you take a look at the fact that we are seeing this fading performance here within some of those larger cap tech names, I guess the question is to what degree then does that maybe diminish the appeal of U.S. stocks and boost maybe the appeal of some of that international opportunity?
Yeah, one of the other interesting elements that we've seen is everyone was calling, if we remember last year, for the great rotation from growth to value, from large to small. What we're actually starting to see is a rotation from the U.S. to the rest of the world. We know the non-U.S. markets, whatever one you might want to pick, broad-based benchmarks, individual countries, have really suffered, and they've suffered for good reason because economic growth and earnings growth just wasn't there. You look at just do a decomposition of the European market to the U.S. equity market. The sectors are vastly different, much more cyclical, not as much of this excitement from tech. And I still think the idea of U.S. exceptionalism still has some legs and probably will, after we sort of get through this uncertainty, especially on the trade side and tariff side, could continue to be supportive for markets. But investors are rightfully looking for other opportunities. And at some point, even with the uncertainty on the tariffs, it just gets too easy to go pick up some beaten down names in some areas that may actually be propelled higher if you believe that the tariffs are really more of a negotiating tool, which they to date seem to be the case, versus really going to be put in place very broadly, very harshly, and almost indiscriminately.
And then, Dave, we also have this sort of like meme feeling bubbling up a little bit, it feels like this year. You know, we were just talking about hims and hers. We're seeing some short squeezes seemingly make their way into the market here. Does that tell us anything about the environment right now, or sort of the willingness of investors to speculate at the moment?
Well, those are your vibes, right? And they're still there, right? It's interesting. So, you know, the OG memes, your AMC, your GameStop, those names, of course, have their lovers and then their haters. But memes have sort of expanded, right? So some people would put a Palantir in that camp, even though they have, you know, a pretty robust business. The stock, of course, was a bit hammered today on some of the spending news out of the government. But the idea that some of these more speculative names, quantum computing, and others. Hims is another great example, can continue to rip higher, shows us and shows me that there still is a lot of positivity in the markets. People don't want to be bearish, but at the end of the day, fundamentals do matter, but right now they are certainly mattering a lot less for some of those names in question.
Yeah, Dave, great to see you as always. Thanks a lot.
Thank you.
Coming up, we'll get to the latest earnings results from Carvana and TOST. Plus, we'll hear from the CEO of Travel and Leisure Company following its latest results. Stick around, much more market domination overtime coming up. Let's take a look at shares of TOST, the restaurant software platform releasing its fourth quarter results. And it looks like the shares went up and now are down by about 3% here as investors try to digest what we heard from the company. So overall, the numbers looked relatively good at first glance. The company says fourth quarter EBITDA was at $111 million. That's ahead of the $100 million or so that investors were looking for. Fourth quarter revenue, $1.34 billion ahead of estimates. And the company coming out with some forecasts as well, saying first quarter adjusted EBITDA will be $100 million to $110 million. That whole range is above what was estimated. 2025 adjusted EBITDA, $510 to $530 million. Again, the whole range ahead what was estimated. So not sure exactly what's going on with the shares here. It's not like they were roaring up into the report. The shares are up about 10% this year. They are up almost 80% over the past year. But nonetheless, we'll dig in a little bit and see perhaps what was going on here.
Yeah, exactly. Even taking a look at some of the commentary within this release, executives saying that our record location ad showing that the momentum within the core customer base, there's a lot to be excited about there. Some of the positive signals across from their even newer customer groups. When you take a look at enterprise, when you take a look at international, food and beverage and retail, also talking about some of the gains that they are seeing there as well. So again, it is a bit perplexing that you're seeing a drop here of just about 3.5% in shares, especially given the underperformance that we saw leading into this report, at least on the day. But again, when you take a look at the most recent quarter, at least when you compare it to expectations, it does look pretty solid here across the board. And like you noted, shares did initially climb.
Yeah, so we'll dig in here and see what is going on. In terms of that record number of new locations the company added, it said it added a record 28,000 net locations that are using the TOST platform. So again, we'll dig in here and see what maybe could be going on.
All right, in the meantime, let's take a look at shares of Carvana. Carvana just releasing its fourth quarter results, and you're taking a look at that stock off just about 5%. So again, some selling there. When you take a look at these numbers, at least at face value, revenue for the fourth quarter beating the street's expectations, coming in at $3.55 billion. The estimate was for $3.34 billion. EPS coming in at 56 cents. The number of vehicle units sold coming in at just over 114,000. That was also better than what the street was looking for. The company giving some guidance here. Maybe this is a bit of a reflection of what we're seeing here in the after hours market. But again, overall, they are expecting some profit growth in 2025 following that record quarter that they did see. They do expect to see sequential increase in retail units sold in the first quarter. They also went on to say that they also expect to see a sequential increase in adjusted EBITDA in the first quarter as well. But again, you are looking at shares under a bit of pressure. It is important to note just the outperformance, though, that we have seen overall over the past several months in Carvana stock as this company has embarked on this turnaround strategy.
Yeah, I think your theory that they didn't give a more specific forecast as the potential reason behind the shares dipping, that is a good theory. The company, just giving a few more of the details here, over the full course of the year, the company selling 416,348 retail units, i.e. vehicles, which was a 33% increase here. And the company talking about and sort of touting that in terms of the number of cars they sold and the EBITDA from the company. So we'll keep tracking it, see what's going on in terms of the shares pulling back and whether that share pullback does stay. But the shares have just enormously soared over the past year. So we have to put that in context as well. Yeah. Well, Travel and Leisure Company reporting its fourth quarter results earlier today, beating on the top and bottom lines. Here to help us break down the report, Mike Brown, Travel and Leisure Company CEO and President. Mike, it's great to see you again. So for folks who are not familiar with Travel and Leisure, who haven't seen you on the show before, largely a sort of vacation club timeshare business, the bulk of your business. And so you guys provide a pretty good window into what's going on travel-wise, right? So just give us sort of high level what you saw in the quarter and what kind of demand you're continuing to see.
Well, it is great to be back with you and appreciate always the opportunity to tell our story. What we saw in the fourth quarter was an acceleration in the final 2 months of the year as we headed into the holidays. It seemed that real close after the election, there just seemed to be, whether it was the elimination of uncertainty or just a change in the overall confidence, it really propelled us to a very strong fourth quarter where we beat expectations, as you mentioned. I think most importantly for us is that momentum hasn't stalled at the year end. We've continued that success in the first half of Q1. And ultimately, we get a daily check on how consumers are thinking about vacations in one of our key statistics called volume per guest. And that remains at an extremely high level for us, more than we expected as we came out of the pandemic some years ago. It shows that people see value, they want to get on vacation and the type of vacation we offer, and that there doesn't seem to be any cracks in the consumer confidence from our standpoint.
Mike, what is volume per guest? That was a metric that we were looking at, in the statement, in the conference call. Explain to us what it is.
So think of it's our version of hotel RevPAR. For every guest that we see, the amount of money they pay for additional ownership of timeshare vacation ownership. So if we see 10 guests and we get $100,000 of revenue, it's simple division that it's $10,000 volume per guest.
Mike, you mentioned consumer sentiment as a macro level indicator on your call. And I bring that up just given some of the trends that we've seen, especially the most recent report when we got the fact that people are getting a little bit more worried about inflation. What does that mean for your business?
Well, this may strike you as a bit odd, but inflation has actually been a big propellant for us in the last 3 to 4 years because 7 out of 8 of our consumers have fully paid for their ownership, which means they're vacationing with dollars that they spent 3 years ago, 5 years ago, and 10 years ago. So imagine if you walk into a hotel and said, I want to pay the 2015 rate for my nightly stay. That's what we offer in vacation ownership. You're prepaying your future vacations. And since everyone has a vacation budget, people have purchased with us. They already see the value. They love the vacations. Economically, it's good for the pocketbook, and ultimately they know that when they're coming to see us, and it encourages them to even buy more.
What about new timeshare owners in this environment? And how many of those folks finance, right? Is that an option that you provide, and how much of a headwind then are higher rates?
So it's a great question in the sense that most of our consumers purchase, the percent finance is roughly 60% of their purchase. And what we tend to find is it's not about the actual full price of their ownership. Everyone has a vacation budget throughout the year. And as long as their monthly payment fits within their budget, they see the value of vacationing in 1,200 square feet. As it relates to interest rates and what that means for us, higher for longer is what we're hearing. And that simply means that 3 times a year, we'll take our portfolio of loans and access the asset-backed security market. So if they stay higher, it squeezes those margins just a bit. But ultimately, we've seen those come down over the past year. And it shouldn't be a headwind for us this year unless they do go back up, or at least a marginal headwind if they stay flat. But I think most expectations are one more cut this year, which means they shouldn't be a headwind against our business this year.
Mike, are you seeing any change in consumer travel plans, especially when you compare the higher end versus maybe the lower end, and obviously that willingness to spend in this macro environment?
Well, I'll look at 3 or 4 different factors to see if there's anything meaningful. And let me share a few of them with you. I think more broadly, this whole work from home environment has really extended our length of stay over the past 5 years. That trend is not abating. In fact, this weekend, I saw Carvana on previous to to this segment. I was over at the Daytona 500, went over Friday, worked from our condo all day Friday, and then watched the Carvana car end up third on Sunday. So first of all, length of stay getting extended. We also watch for booking windows. They're consistently 120 days out. When people get more certain, they shrink to 90 to 80 days, but we're not seeing that. And lastly, we often see shifts from air travel to drive-to as people conserve cash. Again, we're not really seeing any changes in those trends as well, but I can assure you that as the year progresses, we'll check in on those statistics every month or so and see if there is any crack showing in the consumer confidence.
Yeah, it's interesting, Matt, because you talked about that sort of surge in enthusiasm after the election. It feels like, at least from a market perspective, even though we're at record highs again, but it feels like from a sentiment perspective that's wavered to some extent because of things like the threats of tariffs and the back and forth, the things like all of the cuts in DC and those workers affected. Now, you mentioned those different metrics that you have. Are there any other ways? Are you seeing, fewer new buyers, for example, come into the market?
Well, you bring up a good point about the cadence that's come through the pandemic. What we saw is in 22, those all came back to hospitality. And then it seemed like everyone went to Europe to make up for lost time. And then it was cruises. The way we see it today is people have really returned to the norm of, majority domestic travel, occasionally international, back to a good balance between cruise and us. But again, we're watching for forward indicators, and macro often drives that, whether it's interest rates, foreign exchange is keeping people considering Europe this summer, which we have a lot of destinations in Asia. But again, the strength of the consumer as we sit here in mid-February hasn't changed. But there's no doubt we're watching for if unemployment moves up, how does that affect us? And usually we'll start to see that in volume per guest, what we talked about earlier. And that shows up every single day in our KPIs. But again, it's great to be toward the end of February, showing really strong momentum as we head into the last month of the quarter.
Gotcha. Mike, good to see you. Thanks for joining us.
It's great to be back with you.
It is time now for What to Watch Thursday, February 20th. Starting off on the earnings front, some big names reporting tomorrow, including Walmart, Alibaba, and Booking Holdings. Walmart will announce results for the fourth quarter before the opening bell. Analysts expect the retail giant to expand on its robust holiday season, driven by more engagement by higher income households.
Taking a look at the Fed, another batch of Fed commentary coming throughout the day tomorrow, including Chicago Fed President Austin Goolsbee. Now, this follows today's comments from Atlanta Fed President Raphael Bostic. Bostic telling Yahoo Finance that he's not taking anything off the table when it comes to interest rate cuts at the next Fed meeting.
Moving over to jobs, weekly jobless claims data coming out in the morning, and economists forecast the number of claims will tick up compared to the week prior to 215,000. We have seen unemployment spiking in Washington, D.C., as Elon Musk and the Department of Government Efficiency continue efforts to shrink the federal workforce.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern Time for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.